Hello and welcome to this segment of Take 5 with Tony, where we'll be talking about wealth, investment, and Wall Street. Last time we looked at CEO pay and top executive bonuses, and we saw how oftentimes companies give out bonuses, big bonuses, to senior executives even as they're laying off thousands of workers or sending factories and jobs overseas, or in some cases even taking promised health and retirement benefits for their workers and breaking those promises. We saw too how the relationship between CEO pay at the top and corporate performance is oftentimes going in the different direction, that the companies with the highest paid CEOs, on average, had considerably poorer performance. So when it comes to the top pay of executives and CEOs, we don't always get what we pay for. But today we're going to look at that question of getting what we pay for, not just on CEO salaries, but Wall Street and the stock market more broadly. First, I want to pause and just bring up a basic concept, investment. We all know what investment is. It's critical to our understanding of how we build wealth, and also it's certainly fundamental to our ideas of what is Wall Street and the stock market. Now, most of us have been schooled in investment since we were really pretty young, and we've heard that you have to put in a little today to get a return tomorrow, and that if you neglect to invest, well, things deteriorate over time. But if you do invest, if farmers invest in their buildings and their soil, well, down the road their farms are healthier and more productive. And if we invest in our education, a college degree or training as a plumber or a mason, down the road we can usually secure a better livelihood. And for many of us, investing in a home is not only a way of securing a comfortable, safe place, but a way of building equity and wealth down the road. So that idea of investment, of putting in some extra today to get returns later on, that's pretty basic. But does it work that way on Wall Street? The money that we give to Wall Street, the shares that we buy, the stocks we buy, or typically that are bought on our behalf in our 401ks or pensions, what exactly does that money go to? Is it invested in plant expansion, in greater productivity? Does it go towards improved efficiency or reduced energy or environmental impact? Does it go to technologies that improve the quality of the product and perhaps the health and the impacts on the communities nearby? Well, it turns out very, very little of that money actually goes to those things. Marjorie Kelly is one of my favorite writers and thinkers, and in her book called The Divine Right of Capital, she looked at this question of where does money go that goes into Wall Street. And in one part of the book, she focused on 1 year, 1999, and she looked at the total range of Wall Street investments and transactions in that year. And she found that, get this, less than 1% of all the money going into Wall Street in that year, less than 1% actually went to investments in productive activities like new plants, new infrastructure, new technologies. More than 99% went simply into speculation, trading stocks, taking money to buy money to make more money. It's extraordinary. So while most of us might have an idea that investment means putting in a little bit today to secure benefits down the road, that's not the way it works on Wall Street. Not at all. So this probably, as we understand this, it should help us understand why we have so many big booms and bubbles followed by catastrophic bursts. Because the money we invest, and it's often our retirement funds, often is not being invested by Wall Street in productive activities, but instead in speculations that do nobody but a very few any good. Thanks, and we'll see you next time.